Well, good morning, ladies and gentlemen. I'm Mark Dunne, and I'm a growth company correspondent at Shares magazine. I'd like to welcome you here this morning to this session of today's conference, which looks at growth companies. Shortly, you'll hear from the first of 7 directors of such businesses who will be outlining their stories today. But before we start, some housekeeping. Out of courtesy for others, can you please make sure that all mobile phones are switched off? Thank you very much. Now, those of you who have previously attended a Shares event will know the following disclaimer by heart, but please bear with us. The information you hear today does not constitute investment advice, nor an offer to invest in any of the companies presenting. The value of investments and any income from them may go down as well as up. You may not get back all of your original investment. Past performance is not necessarily a guide to future performance. This seminar is intended for educational purposes only and as such, not in solicitation, endorsement or recommendation to make an investment based on the comments of this seminar. Where investment types are mentioned, please be aware that there are other options available. And in short, that means that I and the directors of the companies that follow are not here to tell you what you should do with your money, but to assist your research in helping you understand the risks involved in backing growth companies. Now, a good place to start. What is a growth company? The accepted definition is a business that generates, or the market will expect to generate, positive cash flows or earnings, which increase at significantly faster rates than not only its competitors, but also the wider economy. This contrasts with some of the more mature companies usually found in FTSE 100, such as, for example, utility companies such as National Grid and Severn Trent, which have constant stable earnings but produce little in the way of growth. Growth companies create their own market, or they serve larger or growing markets. Once entrenched, they are difficult to dislodge due to strong competitive advantages and high barriers to entry. Such companies usually stay in growth for several years. Now, growth companies are typically found in the technology and healthcare industries, and a good example of a growth company is Google. The technology giant has seen its revenues, cash flows and earnings grow leaps and bounds since its initial public offering 10 years ago. And those who got in at the beginning and are still holding today are sitting on huge capital gains. The stock has risen more than 1,000% since it went public in August 2004. So, if you bought $1,000 worth of shares in Google 10 years ago, your shareholding today will be worth more than $1 million. It's giving you something to think about, hasn't it? You can almost afford a deposit on a house in Putney with that. Don't just the word almost. Okay, companies with such growth don't come around every day, but they do come around. So how do you spot one? Well, first, growth companies have an innovative product or service. US drug maker Gilead Sciences, for example, launched a hepatitis C drug earlier this year. It's the only available cure to treat the liver disease. And because of that, it sold $5.7 billion worth of the drug in the first half alone. Okay. They also target high growth markets. Again, it's back to technology and healthcare, where the demographics really are driving growth there. Large competitive advantages, such as barriers to entry. It takes a lot of cash over many years to create the next wonder drug or the next revolutionary technology, so it's not very easy. High organic growth with a large percentage of recurring revenues. Repeat business keeps a company competitive and drives continued growth. Cash. It's an important consideration when backing such companies, especially if you're getting in at an early stage. Ask yourself, how much cash has it got? How much money does it burn each month? When will it need more money? If so, how will it get it? If it taps the market for fresh funds, it will hit any future dividends you get as a shareholder when the company starts returning its profits to its investors. How much debt does it have? Companies that pay interest on their borrowings. If it's too high, this could gobble up valuable growth funds. Debt being half its equity, or 50% geared, is usually considered high. But cash isn't the only concern. Many potential growth companies in the development phase are small and therefore volatile. When they launch a new product, report a new contract win, or improve profits, share price usually jumps. The problem is that one hint of trouble, a negative piece of news flow, a delay to a contract or a product launch, and the price of a company can fall, and it can fall hard. Plethora Solutions is a small drug company. It's got a sexual health drug targeting an estimated 45 million men in Europe alone, and not much in the way of competition. In November, as you see on the graph there, the EU regulator approved the sale of its drug. The share price, as you can see, went up. In March, it got a positive update from the US regulator on its submission to sell the drug across the Atlantic. Its share price again went up. Then April came its results. It lost a lot of money, more than it did in the previous year, and down its shares went despite an upcoming expected approval. You can see how volatile such stocks are even when it's generating positive news flow, so the risks there are clear. And this is what happens when things go wrong. Verona Pharma is a respiratory disease company. It's also an early stage developer. Now, a lack of positive news flow has hit the company, especially since March. That was the month it tapped its shareholders for 13 million quid, diluted the holdings of many of its investors. Then in June, trials proved that one of its drugs didn't work in its current form. And you can see what's happened there from March, falling off the edge of the cliff, fortunately. So the litmus test when looking for a growth company is, ask yourself, does it have an innovative product or service that's something that no other company has or is better than what's existing on the market already? Does it target a high growth market? We mentioned before technology, healthcare, the demographics driving those industries such as hospital waiting lists expected to grow in the coming years. Is it protected by high barriers to entry? Mentioned before, investment. It takes a lot of money to get from A to B sometimes some of these drugs or these technology, software, hardware, whatever it may be. Will it generate recurring revenues? Can you see further ahead in years to come where its money's going to come from? And of course, cash. Does it have enough to pay its bills and get its products to market? Is too much of that cash spent on interest instead of funding growth for shareholders? These are all questions you must ask yourselves before looking at a growth company. Okay, thank you, ladies and gentlemen. I hope that has given you an insight into what to look for. Now we have some of those potential companies to explain how they're working on becoming the next growth company. We have a full programme this morning, so unfortunately there won't be any time for Q&As in the room. But if you have any questions for our presenters, please talk to them at the coffee break. I'm sure they won't mind, or in the exhibition stand on one of their stands in the exhibition hall. As you see, we're videotaping all the sessions, which we made available on the show's website, and we'll email you when it's all ready so you can take a look. And now to talk about Angle is Chief Executive Andrew Newland.